business should know. So hopefully as business owners or people who are integral in their business, hopefully we'll get some good tips and some great value out of Elizabeth's presentation today. And thanks for being here.
Thank
Floor
you.
is yours. Thanks.
Thank you. I'm so glad to be here. I thought I was ready.
Sometimes the TV goes to sleep.
Oh, okay. This?
The other one, the red one. Yeah. There it is. It flickered.
It's waking up.
Oh,
Yeah.
it's waking up.
Goes to sleep.
Oh, wait.
I don't know why it does that.
All right. Okay, so, well, as Justin said, I'm Elizabeth Na. I'm a CPA and a business advisor and a contract CFO. All right. You want me to do it again?
It's a pretty long course.
No.
All right.
You see him every day anyway.
Okay, so hello everybody. I'm Elizabeth Na. I'm a CPA, business advisor, and a contract CFO. I'm glad to be here with Lunch and Learn with Office Key. And so today's topic is two numbers that every business owner ought to know, and which one matters the most. So we're going to go over, and you're going to tell me which one matters the most. And so today, before we start, in the announcement, the introduction mentioned that my business started with two startup companies. So I'm going to just start with that. So actually, I worked with the two startup companies, and initially they wanted me to be their auditor. And so that was when I was just starting my business. And even though they were a little bit out of the way, they were in Dayton, and it's about 40 minutes away, but when you start the business, when the customers knock on the door, of course, you will go. So that's how I started my business. So it was, they went through extreme high growth within the first 5 years of their business. They grew each of them grew their revenue to multi-million dollars. And so I think what's also worth mentioning is that going through that high growth period, they even sustained the growth and continue to grow and succeed. So during that time, I was with them and going through that period of time, and they actually launched my business. So we're the two numbers. So we have business owners in the room. So there are so many numbers in the business world. So what numbers do you think are important? So I'll give you a clue. I picked two numbers that are related to the value of a business. So you want to shout out and
Profitability.
profitability. Great,
Yeah.
great. Another one?
Expenses, at your expenses.
That's important. Yeah, we got to control the expenses. Yes. Any other guesses?
Net worth.
Worth? Yes. Okay. There's another one that you probably, I don't expect you to guess that one unless you're selling your
Oh.
business.
I learned a new one.
Okay.
Customer acquisition cost.
Okay. That's great. Acquisition cost. Okay. Good. Good. So, forgot it. Oh. Why is it not doing it? It's not.
Click the button.
Where's the little button? Looks like it's in presentation mode.
Well, this should work. It
Yeah,
worked
it should
before.
work.
Okay,
There you go.
great. Good.
There you go.
Okay, so this is our agenda today. I plan to spend maybe 30 minutes to go over all of this, and the rest of the time, 10, 15 minutes, we can have questions, we can have discussions about business operation. So my background, I started a little bit. So that really just started my business. So it was a great experience, and since I was an auditor, And I did what I knew to do at the time, because right before then, I was the auditor with Deloitte. So that was a good fit. I did the audit. And I also did what I learned from Deloitte doing an audit. And that was every single audit after I finished the audit, I would sit down with a client to go over the numbers with the client, the performance as compared to the previous years in the industry, if the data is available, and talk about their operations and giving them my recommendations for their internal accounting control. And so that really opened up the discussion from them to talk about their visions and their planning about the business. So they really appreciated that session. I think to them, that even values more than just the audit report, because the audit report is for the bank. The bank requires it. So, but after that, I said, no, pull them back from your shelf. I spent a lot of time on this. There are a lot of valuable information that you could use, for operating the business. So I really pretty much just copied that model for the next 3 decades. And I continue to work with small business clients do that way. And it was pretty much my standard. You can say that it's just everything that every time I deliver any financial statements, whether it's an audit, compilation, or review, or a tax return, I make sure that I explain the numbers and make sure that the clients understands it and we can use the data in an effective way. So that's a little bit introduction about myself. So let's see, what's the next one? Oh, I think it's the other way. Oh. Okay, so that's pretty much my standard practice. So that's my work life, pretty much. Work life is an important part of my life. When I started the business, I have 2 young daughters. They were 1 and 3, so now they're married, and and I have 3 grandsons. They're all boys, 3 grandsons. So I love travel when I'm not working. I love to just read and learn different things, and of course, I love to spend time with my grandchildren. Yeah. So, okay. That's the 2 numbers. Those are the 2 numbers, the profit and multiple. Somebody gets the profitability, right? Yes. Okay. So the value. Okay. So what the value of a business boils down to that equation. It's a supremely simplified, of course, but for our purpose, for the illustration of the estimated value comparison, how important the numbers are, we'll just use that equation. So the value of the business really it is what it is in the eyes of a potential investor or buyer, right? So when they're assessing the value of a business, they look at the profitability. That's one factor, but there are many other factors that they consider. They don't necessarily buy businesses that are the most profitable. And there are, like we were discussing with Dave, there are businesses that lost a lot of money, but they have good market share, have a lot of users. Then the strategic buyers will buy them. But today we're just talking about, just in general, how the values of a business is calculated and what's important to build up the value of a business. So let's see what comes up next. But this part of it I'm not familiar because it comes out one at a time. Okay, so I was going to give you an example. Okay, so you may be wondering, why are we talking about the value of a business at this time? So I'm growing the business. Why are we talking about selling my business yet? I'm not selling it. I'm not thinking about selling. I'm not selling it for another 10, 20, or 30 years. So let me share with you a story that a colleague shared with me. So he's got a friend named Mike who used to own a home in Lake Forest, Illinois. It's a suburb of Chicago. So he owned this home for over 30 years, and it's in a high-end neighborhood. It's 10 minutes to the lake shore, 10 minutes walk to the town center. It's just really nice. Mike went over to Charlotte. He loved it there. He bought a house there. He came back to Chicago. He put the house on the market. And but after a year, the house was not sold. So Mike made a painful decision. He pulled the house off of the market, and he did some renovations. So I heard somebody talking about renovating bathrooms, and I did that myself. And that was important to increase the value of the house. And so it was an expensive renovation. He felt that he had to do that. So the renovation was done. He put the house back on the market, and it got sold quickly. So Mike remembered the feeling of resentment initially. He felt that the buyer had taken advantage of him. But then he had this startling insight. He just thought, well, why didn't I do the renovation 5 years earlier? I could have enjoyed a newly renovated home. It's a beautiful home. I could have probably sold about the same price, but I could have gotten it sold much quicker and invested the money and so forth. So anyway, so I just thought that story illustrates, it's a good analogy to the business owners that we're so busy working on the business or in the business, and not thinking about the potential value down the road. Even though we're not thinking about it, but we are building, for a lot of us, the biggest assets that we have. So that's the point of considering the multiple and the profit and multiple, and considering the value of a business. So now I'm going to give you the illustration. So suppose there's a business, ordinary, moderate business with an annual profit of $200,000. And let's say that we use the multiple of 3, which is the average multiple of a business. And so this business will have an estimated value of $600,000. So let's say that this owner worked really, really hard and was able to grow the business by 20%, grow the profit by 20%. So now the business has a profit of $240,000. Now with the same multiple of 3, so we've got the value of $720,000. That's a fine achievement. That's pretty cool. Now, let me give you a different perspective. So let's say the owner worked really, really hard to improve the multiple from 3 to 5. And with the same amount of annual profit, now the business has a value of $1 million. So now, by having the same profit, by increasing the multiple by 3 to 5, the estimated value grew from $720,000 to $1 million. That's $240,000 difference. Now let's say that the owner worked on improving the multiple, and at the same time, the profit got improved by 20%. So then the value is now $1.2 million. So by working through the system that I'm going to talk to you about, potentially the business could double. Initially, we started with the value of $600,000, and now it's 1.2. So that's my point of, between the two numbers, from this illustration, which number do you think matters the most? Multiple. Great. Good. Thank you.
Yeah, and the multiple is associated with the type of industry or doing the business better.
Yes, of course. The multiple, it can be limited, within the industry. So the industry may have a range of multiples, for the business, but depending on the quality, of the business, the potential buyer may assess it at a higher range or the lower range of the multiple.
Okay.
Yeah.
And
So.
would you be giving some examples of some industries and what are typical multiples?
Oh, I do not have those information. Yeah. So, not today. So, any questions? Yeah, that's a great question. Any other questions?
How do you achieve the multiple?
That's a great question. Yes, we're going to go over that.
Okay.
Yes. So, of course, from the buyer's point of view, when he sees, a brand new bathroom, I'm willing to pay a higher price. So I'm seeing all of these things that I consider important, then I'm willing to apply a higher multiple for this business, right? So how do we increase the multiple? Okay, so this is the conclusion. Let's focus on driving up the multiple because it increases, drives up the value of the business more effectively, right? So the solution that I have is the value builder system. Okay, so what I have discovered from my experience, I ran into the value builder system over 2 years ago. And it just really complemented with what I do so much because after I give my best advice to the clients, going through the financial statements, really there's no telling how much they will do. And so the system that I found, so Value Builder system is a proven methodology that has been designed to improve the business value of a privately owned business. And so you see a dial there. So the core of the system is a score. And so the system is divided into 8 key value drivers, basically key factors that would improve, that drives up the business, the multiple that are important from the eyes of a potential investor or the potential buyer. So through the system, we go through the 8 drivers. The core of the system is actually is the score. So the score evaluates how you do in each factor, in each function. And then how do you get the score? There's a questionnaire. And then when the business owners fill out the questionnaire, you get a score. So the score, the value builder systems, the analysts, they came up with this algorithm that once you fill out the questionnaire, we put it into the system, then you get a score. So you get an overall score for the company. For instance, this company has a score of 63, and then you get a score for each driver. Yeah. So how it works is, so we will work with the business owner. Initially, we'll set up the goals, and then we can work on the different drivers. So usually I start with the financial performance and the growth potential. With the financial performance, so of course I already know their accounting and their taxes. So the buyers will see that the history of the business producing revenue and producing profitability, and the quality and the professionalism of your accounting. Of course, if the business is it's being audited or reviewed and compiled by an independent CPA firms, then it speaks. It's different from another one that just comes up with an internal reports. So that's the financial performance and then the growth potential. So it's just how is the business going to grow, the projection, and at what rate is the company going to grow. So that's part of it. And there are other drivers. So for instance, how independent or how dependent the business is on a key employee or key customer or key vendor. And there's the factors that are important in the eyes of the potential buyers. So let's look at, I thought there's a 2-minute video that I want to let you just see. right here. Let's watch this short video.
For your company to be valuable, even sellable one day, there's a lot more to consider than just the bottom line. Will our customers continue buying? Are we too dependent on a key employee or a key customer?
Can you hear it?
Will new competitors start chipping away at our margins? Could my company survive if I was away for a while? Whether you intend to keep growing your business, sell it, or pass it along to others, it's important to understand what drives up or undermines your company's value. That's where the Value Builder Score comes in. It's a system designed to show you how business is really going and identify areas that might be silently dragging down your company's value. The Value Builder Score algorithm was formulated using quantitative research gathered from successful business owners and the mergers and acquisitions professionals who represent them. Take 13 minutes to fill out the Value Builder Score questionnaire. We'll keep your answers in the strictest confidence. You'll instantly receive your Value Builder Score out of 100. Then we'll create a custom report detailing your score based on the 8 factors that drive the value of your company, along with some suggestions for improving your score. Finally, we'll set up a one-on-one consultation with you to discuss the steps needed to increase your company's value. It's confidential and designed to help businesses of all kinds at all stages. So fill out the Value Builder Score questionnaire now and find out how your company is performing.
Okay. All right. Okay, so that's a nutshell about the Value Builder system. Do you have any questions?
So, is this unique? Your business invented the Value Builder
Oh,
system?
no. The Value Builder system has been tested by over 30,000 users, businesses in the world. I've adopted the Value Builder system since over 2 years ago for my CFO business, my CFO clients. Mm-hmm. Yeah. Yes.
Are there some types of businesses in which the Value Builder system is more effective, more helpful?
It's designed for privately held business. So for small business, small to medium-sized businesses, I don't think it's limited to any particular types of businesses. Mm-mm. So when we work together, so I like to work with revenues, business with revenues between $1 and $10 million. Mm-hmm. Yeah. So the clients that I have put them in, on the Value Builder system, they fit into that category. Yeah. But if there are smaller businesses that are willing to work on the system with me, of course, I'd be happy to work with them. Yeah. Mm-hmm. Yes.
What does something like that cost for somebody?
It depends on. I'll have to ask you more questions, if I can, to really tell you, because there is a range. It really depends on various factors.
Is it a one-time evaluation or is it ongoing support?
And so how it works is, so initially we're going to, sit down and go over, fill out the questionnaire. That's the initial step. And so we get a score. And then if we decide to continue to work together, then we pick and choose which module is the most important to you. And I tell the clients, well, which one actually puts more money in your pocket? Which one is the most important to you? We don't have to start with the financial performance, but that is really a mandate. You got to have good books, as a foundation for your business to grow. And so, but we work a module, one module at a time every month. So go through 12 months. And so then after 12 months, then we go through the question, fill out the questionnaire again, just to test the score, to see, because with each meeting, we'll come up with action items. So it will be for someone who really wants to work, because sometimes it touches areas where, you don't want to, if you don't want to work, this is not for you. I mean, I think the value that brings to the clients is clarity, because it really digs down for the business owners to see, oh, okay, I got to do something about it. So in a really relatively short period of time, I've seen great results. I've seen great results because they see it, because the clarity. So it's really clarity and outcome is why I'm really, for the businesses that fit into that revenue categories, I insist on, I put them on Value Builder. And it really just works out very well for them. Yeah. Thank you. That's a good question.
Are you able to show us what the 8 factors are?
Really, it just really shows this very tiny print. But just in a nutshell, that the drivers, I can explain to you what they are. Yeah, so the names really doesn't matter. That's what it is. So for instance, financial performance and growth potential. There's one that's called the Switzerland structure, and that is what I just explained. That you don't want to depend on just 2 or 3 major customers and so forth. So you are dependent, and also the key employees. If you lose this one key employee, so buyers will want to see the business independent. Have no more the customers, not more than maybe 10% of the revenue. So that's that. And there's the cash position. It has a catchy name, but it's just basically if the business, when the buyer takes over, if the business doesn't really require a lot of money, the cash, it's a cash generating business, of course it's more valuable. If it requires you to put in a lot of money, then, it's lower multiple, So, and then there's also the recurring revenue, like Office Key is a subscription business, right? So the proportion of the recurring revenue in the automated billing system that drives up the value. And what else? There's the customer satisfaction. The more buyers want happy customers. Happy customers will come back, do repeat businesses, and they will bring their friends and family over and to buy more. So there are a couple more. Yeah.
I would think the ability to duplicate the business would be a major factor.
Of course.
In size of $1 million to $10 million, there's a lot of service businesses.
Yes.
And if you are a law firm or a financial advisor or something, if you could either buy that business for $600,000, or you could say, I'm going to start off and I could build that business myself without having to pay somebody else for it.
Right.
And
Absolutely.
If you're a manufacturer and you have a patent on a product, then you've got a pretty good indication that someone else can't come in and do that same thing. But if you're a service business and you're depending on that, and there's lots of those same type of businesses, then the multiple may not be as high.
Absolutely. You have figured out the process, and you can repeat the process. Yeah. Of course, that drives up the value of the business. Yeah, it's a great point. Yeah. So, any other questions? Those are great questions.
Do you encourage people to do the test or the survey regularly, even if they're not necessarily wanting consulting at first? I mean, is it kind of a way to entice people to
I can send you, I have hard copies that you can just fill out. Even now it takes about 15 minutes. Or I can send you a link. So you get a score. Yeah. So it shows you, if you're just curious about how I am with my business, sure, there's one way to do it. And then there's, I was going to make this offer. It's just, you fill this out, and it's a no obligation thing. It's I'll give you a 30-minute consultation just to go over the score report with you. So it comes out of the score report. We'll go over them with you in 30 minutes. Yeah. So that's the multiple. And the other number that we don't want to ignore is profit. Profit is important. That's why we go into business, right? Because you remember the initial goal of going into the business, we want to be profitable. Are we making money yet? And, yeah, so that is important. So even for the strategic buyers, buying the business that's losing money. So I was talking to Dave about Slack. They lost $140 million last year, and they're going for IPO for over $100 million. But when the lost business has turned profitable, and with all the other factors being attractive, they will get bought. They will get a lot more attractive, more potential buyers. So profitability is, of course, important. Yeah. One thing that I want to mention, I thought is important to mention, especially for small business owners, is that we all start with we want to make more money, right? We want to sell more. We want to be more profitable, right? And so we're not thinking about the multiple. That's really the next phase of the business growth. But at a certain point of time, the business owners will need to make a decision of not completely focusing on the profitability, on the profits. Because if we're, for instance, in the service business, we're selling our time. And time is limited. How many hours do we have? So then our revenue will be limited. So then at a certain point of time, you got to put your profits away, maybe temporarily, and you got to train up someone, build a team. So even though you're sacrificing your time that you could have gone out to make more money, but you're building up the value by building up the team, right? So that's my point. There is an example that I can give you with a client. So this client of mine, it was about almost 3 years ago, he was telling me, he said, Elizabeth, I don't think I can do this now. It's too much work. I said, how come? Because he was actually making pretty good money. I mean, he started the business as a software developer, so when he was still having a full-time job. And so he started to moonlight, and then after 2 years, maybe a year and a half, so he started, doing full-time. And then what he found out was, my goodness, yeah, there's businesses everywhere, but customers want to work with him. And so he found himself driving over to Dayton, Columbus. He's making pretty good money, but then he said, our savings is okay. My wife is not seeing me, and she's not too happy about it. They have 2 young kids. So he said, well, I can always go back to my job. I was making 80 grand. It's not bad. So that was when he was only working by himself. So I asked him, I said, really? Do you think you'll be happy working for somebody else now? So,
Too late.
well, he paused, he didn't say anything. And then sometime later, he said, you know what? I've decided that I'm going to let go of those service business. I've had it. I make money, but I'm going to just spend a year to develop my own product. Yeah. So that's a great example of letting go of the profit and in building the value of the business, because you got to have a product. He wants to have a product because he figured out when you have a software product, you can sell the product. And then without your own effort, you got recurring business, recurring service, the revenues. So this business now is in a completely different stage. He's got potential investors because he's got a product. He has sold the product. So he's got records, he's got history to show that the product, sales and the services that come with the products. And he has built a team. So the investors are knocking on the door. So really, just last week, I finished the 3-year financial projection for him, so that he could include that in his pitch deck, to the investors, this one investor. So this is an example of letting go of the profit while building up the value of the business. Yeah. So anyway, you have any other questions? Yeah.
Kind of related to that.
Yeah.
I think, you talked about businesses that lose money or just focusing on the value. I feel like in the startup community particularly, and this is maybe painting with a broad brush, but a lot of them are they're focused on the venture the funding, right?
Yeah.
Almost, it seems like from an outsider's perspective, it almost seems crazy sometimes because they're almost just like searching for that funding, but profitability has no place in that system.
Yeah.
Is that a problem? Is that, I guess each business has its own unique challenges and focus and whatever, but I see that from an outsider. You think those people in Silicon Valley or the people down at Union Hall over the Rhine, they're just focusing on, let's get this cash cow investor to come in and give us $5 million and we can build it from there, and then we'll figure out the profitability later when
Right.
we have that cash.
Right. Just through this client, he did the research himself, so, I got to see a company in town that was just exactly, in that example that you raised, that really lost money, has not made money, but it got sold.
Yeah.
But they really took it seriously. They put the pitch deck together. They really go nationwide to search for investors. That's a full-time job.
Focus.
Yeah. But sometimes what's happening recently just reminds me of the dot-com age. It's just crazy. People throw out these millions here. The name has a .com, it's worth a lot.
Right.
Yeah. So, yeah.
So a follow-up question to that is, what are the multiples for that software company? What are typical?
Oh yeah. So the average, it's on your handout, I think. Yeah. So the average business, the multiple is 3.55. And so based on their research, for over 30,000 businesses that had gone through the questionnaire, they filled out the form, the questions and so forth, by their study, if the business can increase their score from 3.55, if they can increase their score, let's see,
80 plus.
to 80 plus, right. So the average score is, I think it's 55 or 52, mid-50s, yeah. So if we can work on the modules to raise, on an annual basis to test it. If you want to test it more often, sure, that's fine. But go from 55, let's say it's 55, to over 80, then the multiplier by their study would increase from 3.55 to 6.1. So from 3.55 to 6.1, that's a 71% increase. That's how they drew the numbers, the percentage. Yeah. So, and actually the 8 drivers are on the second page of the handout.
Okay.
Yeah. Yeah.
So customer score. So do you have to interview all the customers?
There is a way that we can send the customer survey.
Yeah.
Yeah.
Because I work with like enterprise clients, like Johnson & Johnson and such. But they're great customers and they're great in paying on time and everything, but very shy when it comes to giving feedback on revenue.
Oh, yeah. Yeah.
So it
Giving-
might be difficult to get there.
Yeah, yeah. So, so that's, let's see what else I have. Okay.
Does it build value to have employee ownership in a company?
The employee ownership, so that would increase the number of employees. Let's see.
No, not necessarily.
Increase the number of owners.
If you had 100 employees, I'll increase the number of owners.
The owners, yes, yes.
But that would be.
I don't think that I haven't seen their statistics about that in particular, but I have read that doing ESOP, for instance, it does boost the morale and indirectly increases the profitability.
Right, and retention.
Get everybody has a share.
Right.
You know.
Does it complicate selling though? Right.
No, I'm not sure about that. Yeah. Okay, so this is the A dials and the score for each. So, so my hope for you today is that that you have learned something about running a better business by building, improving the business value, so that down the road. So that you're building a more valuable asset, and then you get to call the shot to sell the business, to do something else, or stay in the business. That's all your choice. Instead of sometimes, when talking to the business brokers, a lot of times people are being given circumstances that there would be no time to really do anything. So the business brokers that I've talked to, they've said that more than half of the businesses are not sellable. So that just really, I just thought, wow, I work with a lot of business owners, and I want to make sure that, I'm helping them building value, that they are going to be sellable when they're ready to. Yes. So any other questions?
Sorry to come late and leave early.
No, it's
Oh, okay.
We're right at
Okay.
perfect timing. So
Perfect
thank you very
timing.
much. That was great.
All right, thank you. Okay. Thank you.
Please help yourself to more food. Reminder, we'll be in Kentucky next month with Adam Gross, so join us if you can. Thanks again.
Okay. All right, thank you.
Or Hyde Park, sorry.